The most generous offer on the internet is quietly one of the most ruthless money-making machines in modern finance. 0% interest. No hidden fees. No credit checks that ruin your score. Just take the item now and pay us later. It sounds like a charity. It sounds like the banking industry finally grew a conscience. And the CEOs of the biggest platforms have convinced millions of us that it's just a smarter, safer way to shop and it isn't slowing anything down. There are now more buy now, pay later buttons sitting at internet checkouts than almost any other alternative payment method. Millions of them, glowing in their signature pinks, blues, and purples, processing billions of dollars every year. They are selling to people who just want a little more breathing room in their budget, people who want to treat themselves without feeling the immediate guilt of a drained checking account. Which means the whole business runs on a trick. Not a scam, not illegal lending, and not a glitch in the banking system. Something much smarter. Hiding in plain sight right inside your shopping cart, wrapped in the language of financial empowerment. By the end of this video, you'll know exactly what companies like Klarna, Affirm, and Afterpay are really selling, and the answer says more about modern consumer psychology and the illusion of money than traditional banks ever could. It starts with a $200 pair of sneakers. If you put those sneakers on a traditional credit card and don't pay your bill in full by the end of the month, the credit card company punishes you. They charge you roughly 20% to 25% interest, compounding over time. The math there is brutally simple. The bank makes money directly from your debt. Your inability to pay is their business model. But click the Klarna or Affirm button and the entire picture flips upside down. You pay $50 today and $50 every 2 weeks for 6 weeks. The total cost to you? Exactly. $200. No interest. No extra pennies. You get the shoes today, you keep your cash flow flexible, and nobody gets hurt. Think about your own shopping habits for a second. When was the last time you threw an extra lip gloss, a pair of socks, or a phone case into your cart just because it only added $4 to your bi-weekly payment? If you've fallen for this, and trust me, we all have, let me know what you ended up buying in the comments. Now, back to those sneakers and that zero interest loan. Because it isn't an accident, it was engineered. In traditional banking, the borrower pays for the privilege of a loan. Buy now, pay later runs the entire economic equation in reverse. The price is fixed, the borrower pays nothing extra, so someone else has to bend around the math to make the machine work. These companies bypass you and go directly to the retailers, Sephora, Target, Nike, Peloton, and they charge them the fee. When you buy those $200 shoes, the retailer pays the platform anywhere from 2% to 8% of the total sale. That is significantly higher than the standard 1.5% to 3% credit card processing fee. You might wonder why massive, data-driven brands would happily hand over huge chunks of their hard-earned profit margins, specifically for the privilege of hosting that little payment button. It's because inside the industry, they know exactly what that button does to your brain. Splitting a payment into 4 distinct pieces removes the friction from shopping entirely. A $200 price tag causes hesitation. It makes you check your bank app. It makes you think about your rent. But a $50 price tag? That feels like a casual Tuesday. The fixed objective price of the item never changed, but the psychological price was just value engineered down to a number you can easily swallow. The only decision left is yes or no. And at $50 today, it's almost always yes. That's why the digital baskets fill up. None of this is a secret, by the way. Retailers openly admit that adding these services increases their average order value by 20% to 30%. It drastically reduces cart abandonment, which is the holy grail of e-commerce. The merchant pays a premium fee because the buy now, pay later machine guarantees that people will spend money they otherwise wouldn't have spent. The company collects that premium on millions of transactions a day, quietly, while the marketing out front still promises you financial freedom. The margin lives in that gap, and it never has to announce itself. But to really understand how massive this psychological shift is, you have to look at where it came from. In 2005, 3 young guys in Stockholm, Sweden, pitched a profoundly boring idea at an entrepreneurship competition. They wanted to make online shopping safer by allowing consumers to receive goods before paying for them. The judges hated it. They told them it would never work, but they founded Klarna anyway. For the first decade, it was a European convenience. Then, a few years later in Silicon Valley, a billionaire PayPal co-founder named Max Levchin started Affirm. And down in Australia, Afterpay was born. They all realized the same thing at roughly the same time. Millennials and Gen Z were terrified of credit cards. They had watched their parents drown in debt during the 2008 financial crisis. They wanted debit cards. They wanted control. So, the buy now, pay later industry branded itself as the anti-credit card. They didn't use the word loan or debt. They used words like split, flexibility, and empowerment. They stripped away the scary banking jargon and replaced it with clean, minimalist app designs. And it worked beautifully. They built incredibly sophisticated underwriting algorithms that could approve a customer in milliseconds at checkout using a soft credit check that doesn't hurt your credit score. A machine built for instant gratification, dressed up as a budgeting tool. But a clever merchant fee and a slick algorithm only work if people keep buying. Getting the store in front of the customer constantly is where this business turns ruthless. Buy now, pay later started as a simple feature at the checkout screen, a convenient button. Then, somewhere along the way, these platforms realized they didn't need to wait for you to visit a retailer. They could just become the entire mall. If you open the Klarna, Affirm, or Afterpay apps today, it does not look like a bank interface. It looks like Instagram. It's a highly curated, endlessly scrolling shopping feed. They use your purchase data, which they have mountains of, to show you exactly what you want to buy next. And here is where the second revenue stream kicks in. Every time you click a product inside their app and complete a purchase, the BNPL company earns a massive affiliate marketing commission from the retailer. They charge the merchant the processing fee for the transaction, and they charge them a lead generation fee for sending you there in the first place. They are double dipping into the retailer's pockets by controlling your attention. And then, underneath the pastel marketing and the shopping feeds, there is the darker math. Run a machine this massive, process millions of loans a day, and things inevitably start slipping through the cracks. While the core pay in 4 model is often genuinely interest-free, the reality of human behavior is that people forget. Millions of consumers miss their bi-weekly payments. Depending on the platform, missing a payment triggers late fees. In some years, late fees accounted for a massive percentage of overall revenue for certain platforms. But even when platforms abolished late fees to look more consumer-friendly, they found another way to extract the margin. They expanded into longer-term loans. Try to finance a $1,500 couch, a $2,000 electric bike, or a $3,000 dental procedure over 12 or 24 months. And suddenly, you aren't in the 0% utopia anymore. You are placed on an interest-bearing loan, and those interest rates can climb as high as 30% or more, depending on your credit profile. The 0% offer at the checkout is just the loss leader. It's the free sample that gets you into their ecosystem. The heavy, interest-bearing loans and the late fees are the safety net that catches the platforms when you stumble or when you decide to buy something genuinely expensive. As this machine grew, it created a phenomenon that economists and regulators are just now starting to understand: ghost debt. If you take out an auto loan, a mortgage, or max out a credit card, the major credit bureaus know about it immediately. It sits on your file. Banks can see exactly how overextended you are. But for years, the vast majority of pay-in-4 loans were completely invisible to credit bureaus. You could theoretically owe $500 to Klarna, $400 to Affirm, and $300 to Afterpay. And to traditional banks, you looked completely debt-free. Consumers were stacking invisible loans on top of each other. The regulatory bodies, like the Consumer Financial Protection Bureau in the US, began issuing warnings. They realized that this frictionless button was allowing millions of people to dig themselves into a hole that didn't exist on paper until they inevitably defaulted. When things go wrong, these platforms will absolutely send your unpaid debt to a collections agency, and that is when your credit score takes a brutal hit. The ease of entry is matched only by the severity of the exit. And here is the part nobody saw coming, the twist that proves just how deeply this system has embedded itself into the economy. This model was originally built for the customer who runs out of money before the month does. It was marketed heavily to younger, cash-strapped shoppers buying fast fashion and cosmetics. And for a while, the industry quietly grew fastest when the economy hurt most. But recently, a fascinating and terrifying demographic shift occurred. The fastest-growing group of new buy now, pay later users are households earning over $100,000 a year. Six-figure families are in the digital aisles, using these apps not to buy luxury sneakers, but to finance everyday necessities: groceries, gas, utility bills. They are filling baskets next to the customers the platforms were originally designed for. Inflation did that. When the cost of living spikes and the middle class starts feeling poor, it shops the way the poor have always shopped. It looks for ways to delay the pain of payment, which reveals the strangest, most resilient property of this business. It grows on the way down when its core customers desperately need to finance a winter coat or a repair bill. And it grows on the way up when everyone else trades down to join them or uses it to finance a luxury vacation. There is almost no economy in which buy now, pay later loses. It is a calculated bet on financial stress, and financial stress always shows up somewhere. Wall Street worked this out eventually. When times are tough, investors look at these companies as a bizarre kind of recession hedge. Misery, it turns out, is a fantastic tailwind for the business of delayed payments. So, that is how these platforms make money. And it was never really about the 0% interest. They engineer psychological packages down to hit a magic number. They charge retailers a massive premium for the resulting sales boost. They lock you into a meticulously designed shopping ecosystem to harvest affiliate fees, and they let your natural, human desire for immediate gratification do the rest. The 0% loan was never the product. You were the product. The feeling that here, at least your money stretches further than it actually does, is exactly what you are buying. And underneath it all sits one uncomfortable piece of math, older than any of these tech companies. Debt is simply being repackaged as a budgeting tool. Buying in small installments has always been a cost of not having money up front. These companies didn't invent consumerism, and they didn't invent debt. They just built 30,000 lines of code on top of it, wrapped it in a frictionless button, and became the most common checkout option in the world. If you enjoyed learning about how these platforms really make money, make sure you like and subscribe. It helps the channel out a lot. And if you're interested in how other businesses and industries make money, check out our video on how Rolex manufactures artificial scarcity, or the full playlist on the channel. We'll see you in the next one.